Good afternoon, students. Good afternoon. Can you hear me? Can you hear, students? Can you hear?
Yes, sir.
Okay, thank you. Uh, in the last session, we have talked about foreign exchange rate risk. In this area, we have already discussed some of the things. Foreign exchange rate, and that there are three types of exchange rate risk. First one is transaction risk, translation risk, and economic risk. So we have already discussed about this transaction risk and translation risk. So primarily the transaction risk occurs during the exchange, the buy and sell, or when they're dealing with a foreign exchange transaction, foreign transactions. And translation risk occurs when they convert their balance sheet items from one currency to another currency. So it's normally occurs in foreign operations such as subsidiaries. And now we are going to discuss about economic risk. Right, economic risk. So economic risk is the risk that adverse the currency movements will affect the customers' core businesses rather than individual transactions. So it's basically economic risk will impact on economy as whole. It is not specifically for one or a particular industry. It targets all their businesses which are involving in the foreign exchange rate. This risk reflects basically the risk to the firm's present value of future operating cash flows from exchange rate movements. So it's basically impacts on their future cash flows. Say for example, a particular company in our country is doing business with Singapore. Unfortunately, there is a restriction imposed by the government of our country or Singaporean country. In such a cases, there will be impact on their future cash flow. So, if our country involves in export of items to Singapore, so our company will lose some sort of income from Singapore. And if a company imports items from Singapore, we are unable to settle their money. So as such, it unable to get materials or and so on. So there are a lot of consequences. These consequences may be positive or negative, right? So anyhow, this risk arises from economic risk of foreign exchange rate. So it impacts all the businesses in the economy, in the country. In essence, economic risk concerns the effect of exchange rate changes on revenue, so domestic sales and exports, and operating expenses, cost of domestic input and imports. So economic risk is usually applied to the present value of future cash flow operations of a firm's parent company and foreign subsidiaries. So economic risk not only impact on transaction and translation of exchange rate, so it's impact every moment, every corner of businesses operate in such particular economy. So with increasing globalization, so because of the network, because of the internet facilities, so because of the technologies, now each and every countries are interconnected. Due to that, with increasing globalization, capital moves quickly to take advantages of changes in exchange rate. Now many people, many investors involving in forex, foreign exchange trading. So if there are any movements up, or so whatever the movements, the speculators involving in the foreign exchange trading, they try to use that movement. So devaluation of foreign currencies can lead to increased competition in both overseas and domestic market. So think about what happened if our country's currency devalued continuously against US dollar. What happened? So we can observe the, the prices of products and services in the market, in the domestic market, become higher. And when we export, the revenue, so in the revenue may be in a higher form, but in case of export, in case of import, we have to spend a lot of amount of money than previously in case of devaluation. So one measure of economic exposure involves classifying the firm's cash flows into income statement item and then reviewing how these earning forecast in the income statement changes in response to alternative exchange rate scenarios. So how do they measure the economic risk actually? So they have developed different scenarios. So they prepare forecasted income statements. So they may imagine, they may simulate. So what happened if a currency devalues? So how much the sales value, how much cost of sales, how much gross profit, how much admin expense, like that. So they have construct different scenarios. If US dollar price increased by 5 rupees, what will happen? What is the scenario? So what is the impact on profit? So if US dollars price is increased by 2 rupees, so what will be the scenario? If the price of US dollar decreased by 10 rupees against our country's currency, so what will be the scenario? So this kind of scenarios, so they have choose the different alternatives to measure their economic exposure arises due to foreign exchange rate. So in general, firms with more foreign cost firm with more foreign cost than revenue will unfavorably affected by stronger foreign currencies. So think about, our currency is very weaker than US dollar. So it means our currency is devalued. So what will happen? So if we import from USA, so once our currency value is devalued continuously, so what will happen? The amount we have to pay to US company will increase. Then cost of items, cost of import will increase. So it adversely impacts on revenue of adversely impact on revenue of the firm as well as cost of the firm. So in general, firms with more foreign cost means what? Especially they targeting on import foreign cost, then revenues will unfavorably affected by stronger foreign currencies. In case of revenue, so what will happen? Revenue, so export, think about export. So earlier US dollar was 200, now the US dollar will be 250. So for example, after 6 months or after 1 year, so when they receive the foreign exchanges, then the income the revenue will be increased. It's a favorable movement due to the foreign exchange rate risk. So another method of assessing the firm's economic exposure involves applying regression analysis. Regression analysis to the historical cash flows and exchange rate data. Now we look at an equation. So this is the basic equation. So where you can find here PCF. So this is the cash flow, right? So here PCF is equal what? The changes, percentage change in inflation adjusted cash flows measured in the firm's home currency over the period, right? So this is the cash flow, right? Cash flow is measured especially risk inflation adjusted cash flow. Inflation adjusted cash flow in terms of foreign currency, sorry, in terms of domestic currency. So it depends on E. So what do you mean by E? So A0, A1, this is A0 is a constant, so A1 is the beta value of E1. So what do you mean by E? So E here is the percentage change in the currency exchange rate over the period T, right? So they feed the data. So they feed the data of exchange rate, and here feed the data on inflation adjusted cash flows. So when they run regression over the period, so we will get the coefficient here A1 and A0, we will get the coefficients. So based on that coefficient we can interpret whether it has positively impact or negatively impact, and whether its impact is significant or not. So what is the magnitude? So based on that we can interpret how the economic risk exposure on the business cash flows. So the regression model may be revised. So this regression model can be further revised to handle multiple currencies. So you may here in this equation, this is what a simple linear equations where we can put only one independent variable. So that is for example US dollar. So if you want to add more currencies, so we can add. So now instead of error term we can put A2 into, so what are the D, sorry, F, G, H, I, J, whatever the letter you can put. So for E you can put US dollar exchange rate, and actually the change, right? The change, and you can include changes in the euro, changes in sterling pound, like that. So the regression model may be revised to handle multiple currencies by including them as additional independent variables, or by using a currency index composite. So by changing the dependent variable, right? So this is what dependent variable. By changing the dependent variable, the impact of exchange rate on the firm's value as measured by stock prices, earnings, export, sales, etc. may also be assessed. So you can put here, you can put stock price, earnings, firm's earnings, exports, sales, etc. you can put here, right? By changing the dependent variable, the impact of exchange rate on the firm's value, right? Earnings, export, sales also will be assessed, right? So in the future research you can do research in this area. Very simple. Now we'll discuss about measurement of exchange rate risk. How to measure the exchange rate risk? So measuring currencies, measuring currency risk, measuring foreign currency risk may prove difficult. It's difficult, right? At least with regard to translation and economic risk. So think about it, translation. So can you forecast the future exchange rate, right? Translation. So when they convert balance sheet items which already initially expressed in local currency, now they are going to translate that value in their foreign currency. So that is translation and economic risk. So anything may happen in the economy. So it's based on the economic situation of the country and along with a government policy. At present, a widely used method is the value at risk VaR model, right? So this is a very popular model used in assessing risk. It's not only used in exchange rate risk, but also it used for different scenarios. The value at risk VaR model, V small a R, value at risk. So what is the value of a underlying asset at presence of a particular risk over the time, right? So that's called value. So what is the value of underlying assets at particular time considering the risk? So the VaR methodology can be used to measure variety of types of risk, helping firm in the risk management. So especially in the risk management, so they are using VaR. So the VaR measure of exchange rate risk is used by firm to estimate riskiness of foreign exchange position resulting from foreign activities. So most of the firms, not only export or import firms and banks, so what are the firms that encounter with foreign exchange rate, foreign exchange transactions? So many firms use the VaR, value at risk model, to assess their risk. So the VaR model helps to determine what is the maximum amount of loss. So what is the amount of maximum loss? So including the foreign exchange position of its treasury over a certain time period under normal conditions. Now we'll discuss a little bit detail about value at risk. So VaR, value at risk, is an estimate. So estimate of the worst possible loss, very bad possible losses. So that is decreases in the market value of foreign exchange position. So decreases in the market value of foreign exchange position. An investment could realize over a given time horizon. So think about we keep the stock, we keep the foreign exchange. Foreign exchange is an asset. So if we have 1 billion US dollar, so there's a fluctuation in exchange rate. So if the currency fluctuates in adverse manner, so how much will be our loss? Our loss. So that kind of, so in the present scenario, so what is the maximum loss it can be occur? So they estimate under the normal market conditions defined by a given level of confidence interval. You might study in statistics, 90% confidence interval. 90% confidence interval mean, so there's a chance to become error 10%. So 90% confidence interval mean, so there's a chance to be falsified at 5%. 99% mean, so there's a 99% of chance that the things may happen as they expect, and 1% chance is rest for the unexpected risk. So right here, daily VaR. So normally the value at risk calculated on daily basis. So daily VaR, what does it mean? Daily VaR, what does it mean? If the reported daily VaR at 5% probability or 90% confidence level. So if you have 95% confidence interval, there's a chance for error that's equal to 5%. If your confidence interval is 99%, your chance for error 1%, 99 1, right? Right. If they reported the daily VaR at 5% probability or 95% confidence level is 6.6 million, right? They have estimated that the VaR daily VaR is 6.6 million. Then maximum amount that I expect to lose on any one day in 19 out of the next 20 days is 6.6 million. So it estimates what is the maximum amount if the condition, if prevailing conditions exist in the future in the next 20 days. So they estimate how much the maximum amount of loss may incur. So that estimation can be done through VaR, value at risk. So I expect loss more than 6.6 million only one day in every 20 days under normal conditions, that is 5%, right here. So the 95% chance, it has a 95% chance that if the present conditions move very adversely, right, you can lose 6.6 million. But again, so there's a chance of 5%. There's a chance of 5% that our estimations may become wrong. Then our forecast also will be wrong. So I expect to lose more than 6.6 million only one day in every 20 days under normal market conditions, that is a 5% time. So VaR calculations depends on three parameters. Holding period. The first one is the holding period. How many days a particular investor keep the foreign exchange rate in their hand. So holding period. So that is the length of time over which the foreign exchange position is planned to be held. So the typical holding period is 1. So in the calculation of VaR, so normally people take 1 day as a holding period. Second parameter is confidence interval, confidence level. So confidence level at which the estimate is planned to be met. So the usual confidence interval, confidence level are 99% and 95%. The third parameter is the unit of currency. The unit of currency to be used for the denomination of VaR, value at risk. As proposed by Basel Committee on Banking Supervision, the banks are now allowed to recalculate capital requirements for their trading books and other involved risk based on value at risk concept. So, and Basel 1996 and in Basel Committee, VaR is recognizing as the most comprehensive benchmarking for risk. Again, value at risk. If the foreign exchange position has 1 day VaR is 10 million. So, for example, so the example is given here. What is that? What it says? The 1 day VaR. 1 day VaR, value at risk. The value is 10 million. So what does it mean? So at 99% interval level, right? We want 3 things. So we want confidence interval, we want the foreign exchange rate, and the number of holding periods. So we have all three. So the firm should expect that with a probability of 99%, the value of this position will decrease. So will decrease by not more than 10 million. during one day, provided that usual conditions which prevails over the one day. It means in the normal conditions, if condition exists at worst level, the maximum amount of loss that a bank can expect is how much? 10 million. The maximum loss at the present scenario is 10 million. Anyhow, uh, there's a 1% chance. Our confidence interval is 99%. No, so again there's a 1% of chance that their their foreign exchange, their loss may be exceed the 10 million. It is not a usual scenario, bad scenario. So what does it mean here? One day VaR at 10 VaR rupee US dollar 10 million at 99%. So what it means, in other words, the firm should expect that the value of its foreign exchange rate position would decrease not more than 10 million on 99 days out of 100 usual times, right? So in that agreement we are we intend to keep the assets for 90 days. So, 100 days. If the 100 days, then 99 days the loss may not exceed the 99% of chance. It means 99% we can assure that the risk factor, the maximum loss is 10 million, right? Sometimes, so in that scenario it may exceed, so there's a chance to make loss 1%. So out of 100 days, so there's no chance, there's a little chance to occur about, right? Okay, again 1% chance we have. So 100, so for make it simple, so in 100 days, 99 days, we can expect that the loss not more than 10 million, but there's a chance, 1% chance, where out of this 100% the loss may be exceed 10 million. It may happen only one day in 100 days holding period. So it's abnormal period, abnormal loss. So types of losses. So expected loss, unexpected loss, extra loss. So expected loss, so you know what is a normal loss. We call it as normal loss in accounting process costing. So expected loss, statistical estimate of losses means. So what is the average losses normally incurred in the production process or service product producing times period. So expected loss, so a statistical estimate of the mean, and normally everybody expect. So unexpected loss, suddenly there is something may happen, so due to that there is a chance for unexpected loss, like accidental loss. So maximum loss at specified specified tolerance. So extra loss, so somewhat higher than maximum loss, so higher than unexpected loss with very low probability, So value at risk is the unexpected loss, and tolerance level is the probability of loss occurrence that is more than maximum of the predicted loss. Therefore, to obtain VaR, it can be appropriate to focus on left tail of the return distribution, loss distribution. You might studied about normal distribution, normal diagram, right? So that part we are going to discuss also. So VaR is defined as the highest loss over a certain period of time at a given confidential interval. Confidence level is in VaR definition on deposit, on risk aversion, level of industrial involved with this issue, right? This is the equations. You can refer by yourself. I am not much go in detail. Right here, probability of here, this is a value at risk. So value, this is value at risk. So this is a function of integration. So different derivatives. So derived function of value. So 1 minus confidence interval C. So right, you can refer by yourself. So this is the distribution. So this is the mean. This is the mean. Normally we expect the mean, but here in the VaR we take expected mean as this top value. So in this right hand side, if any things will occur, is favorable. So favorable mean what? The profit. So, is more than 0 is profit. This side loss. So they marked probability, right? This is value at risk. So it may be price may be reduces, or due to the price exchanges, the value of the underlying assets may reduces up to this level. So this level, this is what 90% confidence interval, where the loss may occur in this range. So there is a chance, if the confidence interval is 99%, so that's a 5% chance to go to move beyond this line. So normally people keep above the line in the price, the equations. So confidence interval here 95%. The normal market condition. What do you mean by normal market condition? So the return that account for 95% of administration of possible outcome, and the abnormal market condition. What's abnormal market condition? So the return that account for other 5% of the possible outcomes. So now let us discuss about market risk. So in the market, the prices are determined. Prices of goods and services are determined. Likewise, in the financial market, the traded instrument like stock and foreign currencies, interest documents, treasury bills, treasury bond, and corporate equity shares and preference shares. So these are the financial assets, so which are traded in the foreign exchange. So sometimes there are some fluctuations, there are some up and downs in the prices of such particular coconut or particular items, right? So the price movement, so sometimes the price movement may help us favorably, sometimes unfavorably. So we already discussed about exchange rate risk. Now we have moved to the market risk. It's a new kind of risk, market risk. So market risk result from changes in the value of securities. Securities include what? The bond, equities, debentures, treasury bill, treasury bond, like that. So due to changes in financial market condition, such as interest rate movements, exchange rate movements, and other equity prices. So normally nowadays banks are switching to they are very interesting in dealing in the stock market. They are providing underwriting services or other services. So a bank pursue a new service related to the trading of securities. So the exposure to the market risk has increased. So bank face increased market risk because of their increased involvement in the trading of derivatives. So if the banks, financial institutions now are interesting to deal with financial instrument. So banks, financial service institutions that keeps more assets on more assets in their uh, more assets in the market, so it may adversely impact. So how to measure market risk? Banks commonly use value at risk. Banks, so here the term value at risk. How to assess the market risk? Using value at risk. So we already discussed the value at risk is not belongs to the foreign exchange rate risk. So rather it can be used for many scenarios that deal with risk, that are related with risk. So here the banks commonly use value at risk to measure the exposure market risk. So involves determining the largest possible loss that would occur as a result of changes in market prices based on a specified on contract value. So the bank estimates the impact of an adverse scenario, right? They are not estimating about the profit. They are not estimating the favorable conditions. So they are estimating, they are measuring the expected maximum loss in the normal situation at their present situation exists. So using VaR method, the banks can ensure that it has sufficient capital to cushion against the adverse of the some scenarios. So the bank revision of market risk measurements. So time to time the markets revise their risk they are monitoring their risk. So banks continually revise their estimate of market risk in response to changes in their investment and credit position and how to change market conditions. So how JP Morgan assess the risk? Here it uses 95% confidence interval to determine the maximum executed one day loss on its department in its investments and credit instrument due to changes in interest rate, foreign exchange rate, equity price and commodity prices. So relationship between bank's market risk and interest rate risk, right? So interest rate is very severely impact on financial institutions like bank and other institutions. So a bank's market risk is partially depend on exposure to the interest rate risk. So banks give special attention to interest rate, so risk rate, because it's the most important component of the market risk. And a bank could reduce its environment in the activities that cause a high exposure. So example, reduce the amount of transaction in which it serves the guarantor for its clients, or reduce the advertisement in foreign debt securities. So the companies want to try to avoid kind of a small investment, right? So bank could reduce its involvement in the activities that cause high risk. So the banks are trying to avoid some kind of potential risky investments. So reduce the amount of transaction in which it serves as the guarantor, right? Surety for the security purpose when somebody gets loan, or its clients, or reuse its investment in current debt securities. Now we look at the operating risk. So we have already covered the market risk. So operating risk is the risk resulting from the bankers, bank's performance, general business operating related to first inflation, information, execution of transactions, a damaged relationship with client, so legal issues, regulatory issues. So when a company operates on daily basis, the day by day activities, there are some incidents may occur. That incidents may adversely impact on the company's performance, the bank's performance. So if there is any misunderstanding or disagreement between manager and depositor, what will happen? So they may withdraw the money. So there's a damage and there's some clash. So wrong informations, as there are some circulars come out, so that may impact on the operation of the business. So now we talk about a risk of governance. How to govern the risk? How to govern the risk? So it has been observed that one of the reasons for the failure of banks is improper governance issues. So you might study about corporate governance in accounting. Right, banks is improper governance issues where the relationship, where the ownership and the decision making is concentrated. So very little number of shareholders are trying to control all the entity. So they are influencing much. So and ownership and decision making is concerned with the main shareholders or few shareholders linked to the main shareholders. So thus strengthening the corporate governance by institutions of ownership limitation is another timely regulatory measures which is proposed to be introduced, right? And strong corporate governance process and practices facilitate the conduct of the finance business in a responsible and accountable manner to promote safety and soundness of individual banks, thereby leading to stability of the sector. So there are risk arises in different ways and different names. So why many firms bankrupts, why they are unable to face the risk? So because they don't have a proper governance system. So if there is a good governance system, there will be some board members who are responsible to monitor the risk. So there are many things you might study in corporate governance to misguide the organization. So now it's a challenges and threats faced by finance sector in Sri Lanka. So now we discuss in Sri Lankan point of view. The sector outlook in the short and medium term will be challenging due to subdued economic growth. No, right? Our economic growth is subdued. So it's give a risk to the banks and financial institutions. So many borrowers are unable to repay the principals and the interest. So enhancement of minimum capital requirements. So when central bank requires the banks to increase their reserve minimum capital requirements, then that also will be challengeable to the institutions. The higher loan loss provisioning in line with SLFRS 9 and lack of best practices in corporate governance of the sector is a very important challenge. So these factors have caused a rising of non-performing loan. So non-performing loan means what? So there are some borrowers, the customers, they are properly settled their principal amount or interest or both. So these factors have caused a rising non-performing loans, declining profitability, increased risk profiles and muted growth prospect for the sector. So central bank will intervene right? So uh, some financial institutions are going at risk. That time central banks will intervene. So central banks will intervene proactively against non-compliant, distressed and high-risk licensed finance companies. So which will include imposing regulatory actions such as restriction on the business, suspension of the business, and cancellation of licenses. So why they do? To protect the depositors. So improvement of economic activities, investor confidence, political stability of the country, and ongoing regulatory actions will have a positive impact on the outlook of the licensed finance companies and specialized leasing companies sector in the medium term. So challenges here: inadequacy of capital, increasing provisioning requirement, non-rectification of supervisory concerns, increasing risk appetite of licensed financial companies are challenges faced by the finance sector in Sri Lanka. And solution against distressed and high risk of licensed finance companies, how they resolve this kind of risk. Central bank has an internal rating system, right? Central bank has internal rating system and early warning system. It has both system to identify high risk licensed finance companies to take proactive measures. Accordingly, central bank has taken a myriad of regulatory actions against distressed and high risk licensed finance companies in order to safeguard the interest of depositors of licensed finance companies. Central bank has imposed restriction on deposits, lending and borrowing on licensed finance companies which have not complied with regulatory and requirement. So with regard to distressed licensed finance companies, the central bank appointed management panel, right? Central bank appointed management panel to manage the business's affairs and facilitate repaying of deposits. Further, regulatory actions against the wrongdoers to recover the loss caused to licensed finance companies by the actions, including impounding passports and seizing personal bank accounts and properties, were also initiated during the period of the review. Right, establishment of proper resolution framework will also be carried out in the medium time horizon. So initiatives are currently being taken to resolve distressed licensed finance companies as per the provision of the Finance Business Act. The process of settling the depositors of LFCs, all licenses were cancelled, are being carried out through Sri Lanka Deposit Insurance and Liquidity Support Scheme at present to facilitate expeditious resolution action in respect of distressed or high risk licensed finance companies. Amendments are proposed to Finance Business Act on the resolution framework for LFCs in order to improve public awareness on weak licensed finance companies. The central bank required such as LFCs to disclose regulatory actions taken against them in all publications, including advertisements soliciting deposits and debt from public. So further, central bank disclose the name of LFCs which are subject to regulatory restrictions. So in central bank official website and in central bank report. So that's all. So this later part slides are very important, right?